Good afternoon. This is Stephanie Kennar from the Learning and Development team here at my local aggregation. Thank you for joining us today. Today's masterclass is brought to us by NLG Leasing. We'll be talking about additional services with asset finance that you are able to offer your clients. Today's session, we've left around 45 minutes or so for the content. There will be time directly after that for you to ask any questions of Georgia. Feel free to put those questions forward in the Q&A section as we go, and we'll cover them as we're talking or else at the end. Today's session is eligible for 1 CPD point. So if you are with MFAA, you just simply need to note down today's session in your CPD register, or if you're with FBAA, please just send me a message at the end in the Q&A section and I'll get that event code out to you. So what will be covered today is Georgia's going to be covering the diversity of the product panel, meaning what's available to you, both in residential and commercial products. The opportunity for you to extend your service offering beyond just mortgage broking. How to use the actual software itself, being able to provide a quick quote to your clients and confirm serviceability, and then the accreditation process, the next steps after this session in regards to getting trained and accredited. So I'd like to extend a warm welcome to Georgia. Thank you for joining us.
Very welcome. Thanks, Stephanie.
Great. So over to you.
Perfect. Good afternoon, everyone, guys, and thanks for joining us today. Now, what I'll do is I'll get us straight started. Now, like Stephanie mentioned, you're most welcome to unmute your lines and ask questions as we go, or you can save your questions to the end and we can run through them then if there is any. So what I'm going to do today, again, like mentioned, is I'm just going to run through a bit about our software, the tools available on site, mainly going through a quote and how to do that, and then again, how we would go about getting accreditation if you haven't done so already. So I'm just going to start by sharing our quoting screen. So I'm hoping that that's available to you at your side now as we go. So guys, the screen that you can see in front of you at the moment, this essentially acts as your home page. So anytime you log into our online platform, this is what you're going to see in front of you. This is where you'll do all of your quoting for asset and equipment finance, as well as the ability to proceed through to applications and use our online tools available here on the left-hand side. So what I might start with firstly is running through a couple of the documents that we have available. Now I'm going to click on that. Now we did have a couple of issues with the mouse here, so please, I'm going to open these up and I'm going to walk through them. If there's any dramas, please just bear with me. So again, over on the left-hand side, I'm starting with the documents toolbar and I'm going to open this one up. What this is going to show you is all the documents and supporting documents that we have available to you. And there's a couple of major ones that I'd like to point out. And I'm going to start a little over halfway down with the lender comparison PDF. So I'm just going to download this document, guys, and I'll be just a moment. All right. So I'm hoping everyone can see this there in front of them. This is our lender product comparison. So what it's going to show you there is down the left-hand side are the lenders available in our panel. And across the very top, we've got the products available. So our panel is currently sitting at 29 at the moment. And again, like Stephanie mentioned, that is consumer and commercial products. Now, the reason I like to point this out is to let you know, when we say asset and equipment finance and motor vehicles is certainly something that springs to mind. Absolutely, it's a big part of what we do, but not limited to. So we do have motor vehicles, consumer and commercial. If you have a look for motor vehicle and you look down the list, it's going to show you of our lenders available who will look at what. If you move over to the left, what you're going to see is the commercial low doc products. Your consumer applications, whether it's asset and equipment finance or your standard residential mortgages that you're writing, they are governed by NCCP regulations. So there is no consumer low doc product offering. But if you have a look down at the motor vehicle commercial low doc, it shows you who has that kind of facility. If we continue moving over to the right, what you're going to see is your recreational goods. So that consists of your boats, caravans, jet skis, motorcycles, camper vans. Across, we've got novated leases. I will point out the novated leases, or the lenders that look at novated leases on our panel, they're not fully maintained, but certainly novated leases available. Trucks and trailers, classic cars, commercial fit-outs, unsecured personal loans, business equipment, energy finance relating largely to solar panels, debtor finance, insurance, premium funding, and lastly, unsecured business loans. Now, the unsecured business loans are the newest product to our panel, and I will just clarify, this isn't for startup businesses. The lenders available on our panel that will look at unsecured business loans, they check capacity to service based on the income that's running through the trading entity's bank account. So again, unsecured business loans, but already established businesses. So what I might do is I might jump back to the Documents tab. Beautiful, and I'll go back to the lender documents. Now, a couple of other documents that I want to point out while I'm in here are going to be the checklist. So understandably, for a lot of mortgage brokers, the mortgage is where you're spending the most part of your time. When it comes to diversifying into asset and equipment finance, there's a little bit about understanding what's required for a deal. What I've designed is checklists that are designed to walk you from start to finish as to what will be required. So I'm going to open up a couple and give you an example of what I mean there. So first one I'm going to open up is going to be the commercial low doc checklist. And I do just want to point out that unlike in a low doc mortgage product, a commercial low doc product is more of a fast track product for eligible clients. So it's not clients that have just registered an ABN yesterday and don't have financials and are looking for a low doc. It's more for clients that are established and less risk to a lender, so we have low doc product offering. If it is a brand new, and I'm just opening up this form now, bear with me a second. If it is a brand new startup ABN, absolutely we do have lenders that will look at that, but it's not going to be the low doc product. So again, I'm going to start at the top. So this is the low doc checklist. So if you've got clients that are coming in looking for a commercial chattel mortgage, first check would be to see if they're eligible for a low doc product. Now, at the very top of this checklist, you're going to see the prerequisites your clients will need to meet in order to be eligible for a low doc facility. So the first says asset-backed or 30% deposit. Asset-backed relates to property backing. We will never use the property and tie that in as security. It's simply a yes or a no. If your clients are not property backed, but they're still looking for a low doc product, there is a 30%. Now, some lenders will take 20%. So if they don't have property and don't quite have the 30, please feel free to give our support team a call. But yes, it's either property backing or that deposit required. ABN registered for a minimum of 18 months. Limitations around the asset age, and one of the non-negotiables is clear credit. If your clients don't have clear credit, it's not to say that we don't have a solution for them, but it will not be a low doc product. Underneath that, we've got the details that we need before we're able to provide a quote. Now, the reason I've input this section is because of how many times I'll get a phone call saying, look, I've got clients in there, they're looking to buy a Jeep. What kind of rates could you offer them? Now, unfortunately, unlike with a standard fixed or standard variable mortgage, it's not just going to be one rate regardless. It's basically going to give us a rate based on the risk of the scenario. And for that reason, we need to answer these questions before we're able to provide a quote. So if a client calls you and they say, look, we are looking to make a purchase of a new vehicle, you know, if you answer the next questions on the list, what documents you require prior to quoting, that you'll be able to answer those questions. Now, just underneath that, it says what documents we require prior to submission. For a low doc, and they're probably the most fun because again, they're a non-regulated product, all we'd be looking for is you to jump online, submit an application to us, and the supporting documents would simply be in the form of an NLG privacy statement to be signed, and I'll let you know where you can find that in just a moment. Photo ID in the form of a driver's license, and again for property-backed clients, a rates notice. Now, just underneath what we require prior to submission, it will tell you prior to documentation, which is simply a tax invoice if it's a dealer sale, and then underneath that prior to settlement, which is generally a certificate of currency. But once you get to that submission stage, you'll be aligned with one of our specialists who will walk you through the last couple of steps. But again, for every application type, commercial, low doc, and consumer, there is an appropriate checklist that is going to guide you from start to finish as to the required documentation. All right, now I'm just going to jump back up. Okay, so I'm going to go back to the documents. Now, like I mentioned earlier, consumer loans are still governed by NCCP regulations. Because of that, you will need, when you're submitting a consumer loan, to also complete a preliminary assessment. And just like with the commercial low doc application, if you want to know the requirements, you would be clicking on consumer loan checklist and it will walk you through those. Now, the last two documents I wanted to point out whilst I'm in here are going to be the commercial application form and an individual application form. Now, there are going to be many times of which you're writing an asset finance loan for a client that you've already written a loan for in the past. In those instances, you can use your existing client file and just write directly into our system. But if you've got a client that's new and you want to know what information you need to collect, the commercial application form and the individual application form are like a hard copy version of the questions that the system will ask. So if you want to know what you can take out with you so that you can go and see the client, make sure you're answering all the necessary questions to jump back here to the office and key the loan in, you're welcome to use our hard copy forms. And again, they just act as fact finders. So that's pretty much all I'll probably go through within here. I will point out the privacy statement like I mentioned. And then what I'll do is I'll take us back to the home page. All right. Now, if we just went through the Documents tab and you look up, you're going to see a quick quote, of which I'm going to run through that with you in just a moment. But I'll skip it for the time being and I'll just pop up to the serviceability calculator. Now, your commercial asset finance loans are a little easier because you're going to be looking at your net profit after tax, any relevant add backs, most commonly interest and depreciation. You're going to divide that figure by 12 and it's going to show you the monthly income available to service the new loan. Consumer loans, on the other hand, I recommend you jumping into the serviceability calculator just to verify that your clients do have capacity for the new facility. It is a very straightforward tool to use, and I'll give you a quick example. We're looking for net monthly income, any other income, which could be investment property, kind of rental income, it could be family tax A and B. So we might say that there's a rental income. Now, after that, it's going to ask for personal information. The reason for that is because they're going to take out a general living expense at the back end. So you're going to be putting marital status and any dependents. You'll select residential expense, whether that be in the form of rent, board, or mortgage repayments. And then what that residential type is. Underneath that, you've got vehicle loans. That is for any existing vehicle loans your clients might already have. If there's nothing, you pop down and you select credit card limits. Underneath that, we've got other loans. And again, examples might be investment property loans, personal loans, and underneath that, we've got other expenses. Simply anything that falls outside of the general living expense, which again is calculated at the back end based on the personal particulars that you've entered. Once you've done that, and I will mention, other expenses could be private school fees, gym fees, anything like that. Once you've done this section, you can see available disposable income down at the bottom, and in this instance, it's $2,925 per month. Now, basically, that's telling you what income we have available to service the new debt. What we want you to do is write that figure down, save a copy of the serviceability, and when we jump into the quick quote, you're going to get, based on the details or the vehicle particulars and the details you put in, it's basically going to tell you what the repayment is. Now, we want you to deduct the repayment from the available disposable income and have a surplus of at least $300. If it's not $300, again, it doesn't mean that we're unable to draft up the loan, but it's best to give our scenario support team a call to workshop that application. Now, once I finish off today, I will just let you guys know when I mention our scenario support team, I will get either Stephanie or one of the other team members here to send through, for anyone who's not yet accredited, to send through the documents that we need to complete in order to do the accreditation. And I'll also send through that scenario support line. So again, that's our serviceability calculator. If we keep moving up, we get to a tool called Glass Guide. Now, basically, this is a vehicle valuing tool, very similar to a Red Book if anyone's used that facility before. Now, when you're submitting an application, putting the vehicle particulars in will be a part of the application process. But the reason I pointed out from the homepage is simply because it can be a really nice value add tool to be able to use with clients. If someone mentions to you that they're looking in the next 3 months to make a purchase, you can pop in the vehicle particulars, and I'll give you an example. And it's basically, depending on the avenue of purchase, it's going to spit out a value for us. Okay, so again, if we scroll down, you can see avenue of purchase being whether it's purchased through a dealer, private sale, and you can see the value it's given us. Also a really handy tool to use if your clients have got an existing asset that they're wanting to trade in. As a part of this transaction, you're going to get a trade-in cost there. Now, if you scroll up to the top of the page, you'll notice that you can PDF this document and you can give it to them to take out. So if they are going kind of vehicle hunting, you can pass this on as a guide for them, which I find is a really useful feature. Now, just above the Glasses guide, we've got Client CRM. Client CRM is only going to be used by you guys for one feature. If you've written a loan for someone today, and 6 months from now they come back in and they say, look, business is going really well, we've hired another employee, we're looking to buy another work ute. You did their work ute 6 months ago. You can click on the Client CRM. It's going to pull up all of the details of any applications you've written in the past. You can click on the client's name and duplicate the application to save you from having to re-input all of those details for a new loan. Above that, we've got recent or saved applications. Now, once you start off a loan, at any stage along the process prior to submission, you can save that application. Now, one thing I do want to point out in this section is when you're submitting a loan, and I will let you know when and where this is, but it's going to ask you to tick yes that you have obtained the necessary compliance documents required to submit. The reason for that is because when you press submit, we run what we call either a background or a phantom credit check on the client. It's not going to appear as a footprint and impact them, but we are running that Vita score, and because of that, we need that privacy statement to be signed and driver's license to be received prior. Now, because you're ticking, yes, I've got that, if you get to the very end and you're still waiting on a privacy, please don't submit. Please save the application. Once you do get those compliance documents, you can jump into recent or saved applications. Again, click on the hyperlink, edit, and then submit to us. Now, the very last one we see up here is start application. Now, there's two ways that you can start an application. One of those is going to be to progress a quote through to an application. So if you've got clients on the spot or over the telephone, you run through a quote with them verbally, they say, yes, look, that all sounds fantastic, let's go ahead, through a quick quote, and I'll show you how to do that in just a moment. You can progress an application through. Alternatively, you can start an application. Now, examples of instances where you might just be starting an application mainly relate to complex transactions. When I say complex transactions, I might mean brand new startup businesses or clients who are credit impaired, or really assets that are really specialized, or older assets. So someone might be looking to buy an asset that's 15 years of age. Look, we certainly have a really, really vast array of lenders available to you that we like to think cover off most of these type of circumstances. But those kind of lenders, some of our more boutique or specialized lenders, rather than just being able to put the details of the asset in, they have a little bit more information required about the profile of the client prior to providing a quote. So if something is more complex of nature, you won't be using our quick quoting system, you'll be using our support team. You'll give them a call, they'll provide you with a quote over the phone, email that quote to you, and then rather than progressing a quote through to an application, you'll simply be jumping up here, selecting Start Application, and you'll attach the quote provided to us to the application at the end. So you can simply, instead of going through a quote, you select the application type and you walk through from there. Now what I'm going to do now is I'm going to jump back to the quick quoting screen and I'm going to run through a quote. All right. Quick Quoting's tool is a really straightforward tool to use. It's divided into 3 sections, and I'm going to start on the left-hand side with step 1, which is choose your finance. If I click on the drop-down box here that says Finance For, what I'm looking to select in this field is the asset that's being purchased and the application type. Examples being boat finance consumer, motor vehicle finance commercial. Probably the applications we see most of is what I'm going to use for our example today. So I'm going to click on motor vehicle finance commercial full doc. Once I make that selection, I then move down to finance type. And what I'm asked to select here is going to be a chattel mortgage or a finance lease. Now guys, I'm not sure of your individual levels of experience with asset and equipment finance, but basically we see probably 95% of the commercial applications as a chattel mortgage. And it comes down to who's got ownership of the asset and at what stage. Your chattel mortgage, your client will own that asset from day one and pay it off over a period of time. A finance lease, on the other hand, is often owned by the financier, and your clients pay a rental over a period of time, often with an option to buy at the end. Now they can be tax effectiveness, depending on which way you're going to look at it. Firstly, we see way more these days chattel mortgages than we do finance leases. But if your clients aren't sure which one is going to suit them, I would always push them back to their accountant to work out which product is right for you. I'll click on a chattel mortgage and I'll move down to finance amount. And in this section, I can just type freely. And the only little note I'll make is please use the quick quoting tool for amounts less than 100,000. When we are looking at 100K and greater, my preference is that you call through to the scenario support team, just because for the higher end or premium clients, we do like one of our staff to be kind of guiding you through the process step by step. Just again comes down to level of experience, and we want you to be really comfortable and we want to make sure that the deal goes off without a hitch. So again, please use this tool for amounts shy of 100,000. Once you've selected the finance amount, you move down to loan term. And before I make any changes here, what you're going to notice is at the bottom of the screen, it's going to, as you make selections, it's going to tell you which lenders we have available. Now this is based on a loan term that's 5 years. Now guys, in the consumer world, it's a lot more common that we would ever see a 7-year loan term. In the commercial world, if I've selected 7 years, you'll notice of that list of available lenders, all of them, with the exception of ANZ, have actually dropped off the list. Now, there's a couple of reasons. So look, certainly we can look at a 7-year. I generally don't recommend it. So I've never offered a client a commercial chattel mortgage over a 7-year loan term, and there's a couple of reasons why. One of those reasons relates to the fact that your commercial assets are generally used more frequently, and therefore the upgrading usually happens more frequently. Now, as well as that, to upgrade an asset more frequently, there can be advantages for businesses relating to their tax. Now, if a loan, meaning a chattel mortgage, is paid off prior to the end of the term, commercial chattel mortgages generally have fairly hefty early termination fees to do so. As an example, if we are going to look at ANZ, who will allow a 7-year loan term, but if the loan is paid off before the end of term, the penalty is going to be 75% of the remaining interest that would have been earned over the life of the loan. That is a significant amount. So again, 7 years is a long time to be locked into a contract. I wouldn't look at it. if we look at 5 years as a standard, and your clients have a look at what that makes the repayment. In this instance, what are we looking at? Metro Finance at a 957, and they say, look, it's a little higher than I want it. Rather than extending the loan term, what you can look at is the option of a balloon. And I'll quickly run through for those that might not know how a balloon works. So probably the standard we look at is a 5-year with a 30% balloon. Now, this can vary depending on the age of the asset at date of purchase, but generally 5 years 30. If we go down to kind of a 4-year, we can maybe look at 35, and a 3-year 40. They're not set in stone, those balloons amount, they're just a guideline for you. But if we do the standard, which is 5 years, 30% balloon, generally it's gonna tell you firstly the dollar figure that works it out to be, which is $15,000. So basically, as a rule of thumb, you can consider that this $15,000 is conservatively no less than the trade-in value of that vehicle is going to be at the end of that loan term. So basically, if we had a vehicle that was new, 50K, over a 5-year loan term, we can consider it very conservative to expect that we're going to receive $15,000 back if they were to trade in that vehicle. So what happens is we are deferring this $15,000 to the end of the loan term. So at the end of that 5-year loan term, there is going to be $15,000 due. So essentially what we're doing is we're setting up our monthly calculating our monthly repayments based on a $35,000 amount instead of $50,000. So essentially reducing monthly repayments, and you can see what that's gone down to from your 900s to your 700s. Now, what happens at the end of that loan term when that $15,000 falls due? Your clients have 3 options. Option A will be a lump sum payment to pay it off, just $15,000 into the facility, close it, and you're done. Often customers, especially business clients, don't have $15,000 lying around to just make a lump sum. So probably most commonly with balloon repayments at the end of the loan term is option 2 would be subject to lender approval. We can look at refinancing that $15,000 over an extended loan period. So if your clients weren't ready to upgrade, but they didn't want to pay that loan off in that one lump sum, we could look at refinancing over an extended period, subject to lender approval, so long as the loan repayments had been made when they needed to be. We shouldn't have an issue in refinancing over an extended period. And option 3, this is probably the most common, is for those clients who do upgrade on a reasonably regular basis. What they can do is they can trade in their old asset, pay off the residual, and then take out a new loan, all as part of the same transaction. So again, a balloon repayment is an option to keep those monthly repayments down, but it is important to get an understanding of what their intentions will be at the end of that loan term. If we then move into step 2, which is specifying conditions, and the first of those we're going to ask for asset age. If I click the drop-down box, you're going to see available to me new up to 20 years. Now, again, one of my preferences is that we use this tool for vehicles or for assets newer than 8 years old. I'll explain the reason for that. Now, essentially, so we'll never take property as security to tie in. We are only going to be using the security from the asset being purchased. Now, essentially, as we're taking an encumbrance over the asset, it acts as your second way out for the lender. So if we look at very worst case scenario and an asset got repossessed, the lender is going to try and recoup their loss via sale of the asset. It is obviously a much larger risk to consider trying to recoup those costs on an asset that's 15 years old at date of purchase than it is in an asset that's new. But a lender might be prepared to take that greater risk for a property-backed client, been at their place of employment for 5 years, reasonable income. Are they prepared to take on the same risk in an older asset for a casually employed, still on probationary period client that boards with their parents? Maybe not. So again, as that risk of the asset age increases, we just prefer to get a bit more understanding about the client profile. So in those instances, again, newer than 8 years, great, use the platform. Older, scenario support team. And what you'll notice is, I might just tick this box here for a moment. Homeowner, again, we will never tie in the property. I don't care if it's unencumbered versus a 99.9% lend, simply a yes or a no question. If I do put in property backing here, you're going to notice that whereas Metro was the lowest lender, ANZ have actually jumped to the head of the pack. Now that's actually indicated by that green line over the lender that's offering the lowest monthly repayments. Now, what I'm going to do is I'm going to change that from new. I'll firstly point out the rates offered are a 5.07 at the moment for ANZ. If I'm to tick non-property owner, you notice the ANZ rates have jumped up quite substantially. Now, again, I'll tick property owner and you'll see how they've jumped down. Now, if I change that asset from new to say 4 years old, what you're going to notice is Metro are now jumped up and ANZ have jumped down. Guys, I'm just playing around with these figures to give you an indication that each lender has a particular pool, appetite, niche that they like to play in, and they'll discount in that space. ANZ's very competitive in the kind of non-startup business, kind of established customers who are property backed, buying new assets. They've got a real appetite for those transactions. As soon as we say client's credit impaired, business has only been trading 3 months, ANZ are going to jump right out. As soon as we say the asset we're purchasing are 10 years, again, ANZ's not going to be in that space. If you look at the rate for Metro, for a property-backed client, you're looking at 5.42. Property ownership hasn't made an impact, and if I change that over to 5 years, you're going to see that Metro are still sitting at a 5.42. As soon as I change that over to 6 years, you're going to notice they jump up. So guys, this was just to give you an idea around lenders that will discount over certain areas, and as you use the tool, you'll come to recognize what those spaces are. Now, again, we'll change that back to new, and we'll keep moving down to payment frequency. Now, this simply allows you to change the payment frequency over to weekly, fortnightly, monthly, or annually. If we change that to weekly and you have a look down at the screen, you'll notice that the repayment is now reflective of a weekly payment frequency. Now, I'm going to skip broker or origination fee for the time being. I'll come back to that in just a moment. The next question we get to is homeowner. Now, again, like I mentioned, we are not using property as security. We're not tying up any of your equity, just a yes or no question verified by a rates notice. Because like I mentioned, some lenders discount for property-backed clients because they view it as a lower risk. If we move down, we get to private sale. Now, private sale is basically, it's really straightforward. Any asset that's being purchased not through a recognized supplier. So if it's me selling my vehicle to you, that's a private sale. Car sales is going to be a private sale. Now, if we're a private sale transaction, there can be additional conditions around vehicle inspection reports and requirements. Don't have that conversation with your clients at this stage. By all means, quote. But what I find is majority of our lenders do require vehicle inspection reports for private sale transactions. But each of our lenders will have a slightly different requirement as to who they use for those inspections. Examples being Westpac and Macquarie will send their own internal valuers out to inspect. ANZ will allow an RSCV or a Marshall batteries. So again, until we know exactly that your loan has been approved by a particular lender, try not to have that conversation with your clients, because the last thing we want them to do is go out and try and organize their own independent valuation and expect that that's going to be okay. Now, if we have a look at, say, an example being Macquarie at a rate of 5.82, and we click on private sale, you're going to notice that Macquarie's rates have gone up for a 6.32, so added an additional 0.5% on. Again, it comes down to risk. Some lenders view it as a higher risk private sale transactions, and those rates will be reflected accordingly. Underneath that, we've got finance fees, and the fees that I'm referring to are two. First one is going to be the establishment fee. The establishment fee is the fee charged by the lender to draft up a facility. ANZ, for instance, you can see is $375. Now, the other fee that we're referring to is a broker fee if you charge one. Now, guys, one thing I want to be really clear about here is one of the biggest competitors that we have in the asset and equipment finance space is going to be losing quotes to dealerships. Now, guys, it's really important that you recognize where it is that the dealers incorporate their costs. You'll have heard before, or you've been, personally experienced before, a lot of the time, dealerships give clients to walk away with simply a rate. So and we come from a rate world, so clients are walking away with saying, oh, look, I'm getting 3%. And everyone knows every day of the week 3% is a good deal. They haven't been given a repayment. They haven't been told whether or not there's administration fees, establishment fees, if those fees are financed in, what the loan conditions are, what the terms are. Simply a rate of 3%. The first thing is transparency. If we're beating a quote or trying to beat a quote, you want something in writing and you want all of that information. And I'll be really honest about the fact that when I reverse calculate, so they've given me that first 3% and I say, look, no good. Tell me repayment, tell me loan term, tell me this, tell me that. When we finally drag out what that repayment is, and I try and reverse calculate to work out how that rate meets that repayment, 50% of the time I can't do it. So that's to give you an understanding of often those rates not being real rates. Forget the interest rates with asset and equipment finance. We are wanting to quote the repayment. It doesn't matter if your interest rate is 40% if your repayment is lower. And this is where the dealers get their clients. So that's one thing to keep an eye out for. And a good way of looking at it, guys, is if you've got an asset like a property, an appreciating asset, and they can walk into a bank and get a rate of 3.99%. Then you've got an asset that depreciates like a motor vehicle, and someone's offering them a rate of 2%. It's a fair indication that these are not real rates. But the lenders of the dealers, have also got more room as to where they can hide those profits. What I mean by that is if you walk into a dealership and recommended retail price of a vehicle is $50,000. Now you don't bargain at all. You go, yes, sign me up. Let's buy the vehicle for $50,000. The dealer's making a fair amount of profit in that vehicle itself, therefore have the ability to offer a rate that's quite a bit lower. If you go in, you hardball, and you get that recommended retail price right down, the profit is less and the rates can't be quite as competitive. But what I'm trying to explain here is dealers have got two places in which to hide how they earn their profits. So guys, please keep in mind, the only thing I'm trying to get out here is that they're not always what they seem. You want to make sure that what you're doing is you're selecting finance fees. So you're giving your clients, by providing this figure here, the real repayment. And you're going to be selling on transparency. This is the real repayment. This is not the figure then plus GST plus this, plus this, plus this, and they're all of a sudden signing the contract for an amount that they've not seen before. These are end of the line figures. What dealers will also do is they will untick the finance fees. That obviously makes the rates low, the repayment lower, and they can charge high-end fees at the start. So again, if you don't finance the fees, there's going to be the establishment fee will be paid up front, and if you charge a broker fee again, that will be paid up front. That is an option to you. Most of the time I find clients prefer to have it all rolled into one so it's neat and so it's transparent. But the system allows you to work out what's going to be best for your clients. Now, I just want to go through now the part that you make for the transaction. So that can be done in one of two ways, either via a broker fee or a commission, and you can charge one or the other or a combination of both, and I'm going to explain the difference to you. So if I pop in $1,000 in the broker fee section here, the first thing I'm going to point out is the column at the bottom of the screen that reflects broker fee. You're going to notice a little warning sign that says limit there. If you exceed maximum broker fee or maximum commission for a particular lender, you will be advised accordingly. And again, if I stick with ANZ as an example, you'll see 770 is their limit. So we can jump up and we can change this over to a 770. Now guys, basically the way this varies is a broker fee, assuming we select finance fees, increases the net amount financed. So again, if we were using ANZ as a lender, you can see we haven't exceeded ANZ's limit, 770, and you'll notice the net amount financed has gone up, but the rates have stayed the same. Broker or origination fee is basically a fee added to the net amount financed, capitalized to the loan amount, included in the repayments. So it's pushing up the net amount financed, whereas your commission is pushing up the rates. And the way in which you want to earn your part for this transaction is going to be up to you based on the knowledge of your customer. So again, some brokers prefer just to say, look, there's a fee, this is what it is, flat fee, no dramas. And that way it's keeping the rates nice and low. Like I mentioned, we shouldn't really be having conversations around rates, and it's a matter of educating your clients in that space. What I'll go through now is just the commission. So before I make any changes to the commission amount, I'm just going to point out there's two columns at the bottom of the screen that reflect rate. One says rate and one says written rate. And at this point in time, while the commission's at a 0, those two columns are mirrored. And what they're reflective of is the wholesale rate that's provided to us by the lender, plus the 30% that NLG Leasing makes for the transaction, which is $300 plus GST. So if you were doing a loan for a family member or a friend and you didn't want to make any money for it, they're real rates that you can see. As you do incorporate your commission into the transaction, the written rate column is going to go up, and that's going to be your effective rate. So again, if we jump over into the commission and we pop in a 3%. Firstly, if you had gone over a lender's allowable limit, the end column entitled percentage NAF, percentage net amount financed, would give you a warning sign like we just saw for the broker. In this instance, it hasn't, so you know that you could charge 3%, which is $1,500. I will let you know that these are real dollar figures that will be paid to yourself through my local broker, but they're basically inclusive of GST and they are not shaded by us. So basically what we make is already incorporated into these rates below. So you don't need to charge an increased amount because NLG Leasing will shade that amount. Absolutely not. They are real dollar figures. Now again, it then tells you that that's $1,500. You'll see what that rate's increased to and how the repayments jumped. Now, if you thought to yourself, I really want to make $1,500, but client is asking about the rate and I don't think they're going to buy that 6.28. You can jump up here and you can think, maybe we'll pop $1,250 in here, which is 2.5%. What that's done is it's a rate of 6.04. Now, if we wanted to do a rate in the 5s, what you can do is you can pop in a commission amount that may be $1,200. It's taking your rates to 5.99%. If you said, but I really did want to make $1,500, you can type 300 in as a broker fee. You're making 1,500. The rates are still at a 5.99%, but the net amount financed has gone up slightly. So it's just a matter of perspective, guys, what works for your clients, how much you want to earn. And it does sound reasonably vague. And I get calls saying, what's fair? What's a fair amount for me to charge? Guys, what I would recommend is don't go in blind. Ask your clients if they're being quoted anywhere else. If they haven't been quoted anywhere else, ask what their expectations are or monthly budget is, because you want to be able to adhere to that. If this is coming up as $176 and your clients have got this idea in their head that they were wanting to pay $100, even if it's the best quote in the world, if they've got an unrealistic expectation of what they thought they would pay, you're going to come in disappointing. So try your very best not to go in blind. Try and have a conversation with them around their expectations before you jump in with a quote. Now, I do just want to show you another feature down at the bottom. Now, at the bottom, you're going to see a tool called the Commission Adjuster. Now, the Commission Adjuster basically allows you to scale up the commission to fit within a particular budget. And I'll give you an example of what I mean. So, you can see at the moment, the repayment minus any commission is is at a 5.07%, and the repayment is 169.70. If your clients are coming to see you and they say, look, we didn't realize you did motor vehicles, we're absolutely happy to go with you so long as you can be 180 per week, which is what the dealer gave us. Rather than chopping and changing the percentage here, you can simply scroll the commission adjuster along until it falls just shy of the repayment they were looking for. So they've said to you, so long as you can beat 180, and you say, brilliant, you're in luck. We've got A and Z with a repayment of 176, and you've calculated your commission at $1,262, which is 2.53%. So again, it's just an additional tool to help you work out what your repayment is. Work out your commission based on a repayment guideline, a budget, or beating a particular quote. Once you do work out the income you'd like to make, so say we did stick with 3%, you jump down to the bottom of the screen and you select PDF quote. It then allows you to type in your client's details so that the quote comes out nicely addressed to them. Now, on the right-hand side, you've got show lenders. Pre-selected is all. Now, just my personal opinion, I'd leave it as all. Part of your value proposition as a mortgage broker is saying, look, I've got no bias to anyone. I popped in your particulars. Here's the list of lenders. Here's why ANZ is going to be in your best interest. But it does give you the availability to narrow that down and just do a select few. Completely up to you. Once you have made those choices, you select PDF quote once more, and I'm going to give you a look at how that quote's going to generate. Now, at the top of the screen, where you can see NLG Connect. If you want, once we get the accreditation finalized, if you want to send me your logo, I can personalize your quotes for you. Now, again, I'm going to give you one of my personal opinions. I would suggest that that's a good idea. Simply because NLG Leasing, we don't advertise in the retail space. You're not going to hear us offering, special rates to clients over the radio or on the internet. We act as a service provider for third parties, mortgage brokers, accountants, financial planners. Because of that, our logo probably doesn't mean much to your clients. If you've got branding that you pay for, that you're happy with, that means something, I would recommend you can send that to me once we finalize the onboarding, and I can personalize your quotes for you. You're going to see the details down at the bottom of the screen, and just if we scroll down, which you're going to see the lenders available to you and the options there in the vehicle particulars. Now, I will let you know that this is indicative only. Because you've provided a quote for your clients, it's not locking that rate in. And the only thing I can probably suggest to you in that instance is use it as a selling technique. If they're happy with the repayment, let's lock it in. Let's get the transaction drawn down. So again, once you were finished there, what you do is you jump up, and I'll just show you once more. So you'd jump back to I can't see the screen at this stage. Give me just a sec, guys. So once you do get the agreement, yes, they're happy to proceed. You jump up, press proceed to application, and that section is going to take you to the information input section of the deal, of which I won't run through, simply because if you've written an application before in the past, this is straightforward. This is the section that the application forms, the manual or the hard copy ones that I mentioned at the start. This is that information input section. Nothing outside of the ordinary. Now, guys, that's probably where I'll stop you, because I am realizing that we've probably only got about 5 minutes until time. So what I might do is I might finish it there, and I might hand over to see if anyone's got any questions or anything that I neglected to cover.
So now's the time. Thank you, Georgia. That was fantastic. So there's a wide range of products available. So it's basically one hub, isn't it?
It is indeed.
To be able to see everything. So if anybody's got any questions now for Georgia, if you could put those into the Q&A section, that would be fantastic. And while we're waiting for any of those, let's just spend a moment talking about the accreditation and training process.
Beautiful. So like I mentioned, what I'm going to do is I'm going to make sure that I send through to Stephanie after today, who will, in the appropriate format, send that out to you, the way in which we go about the accreditation, and also my contact information. So if there wasn't any questions that you had for today, but something does spring to mind, that you've also got an adequate way of jumping on the phone to me, you can touch base, you can run through any scenarios or any questions. So guys, I'll make sure that you've got both the accreditation process as well as my contact details shortly after the training today.
Excellent. So what we'll do is we'll send all of that out to everyone that's attended today, and just outline the process for making contact with Georgia. And if any of you are moving across from another aggregator, the details with our accreditation teams to get those transferred.
Perfect.
Thank you. Yes, thank you, Joshua. I will get those codes out to you. No problem. We do have one question here. Is there a maximum price that the lender will lend for a business vehicle?
Thanks, Robert. I just saw there is not. So our minimum loan amount is $5,000. There's no maximum. A lot of lenders will lend up to the 100% of the purchase price. Some, depending on if there's negative equity, will even go over 100% LTV. It's just going to come down to a case-by-case basis. Every now and again, depending on the risk of a transaction, a lender may ask for a little bit of hurt money in. They may suggest a deposit, but it's certainly not a requirement.
Fantastic. Okay, thank you. Thank you for asking that.
You're very welcome.
Great. So I don't think that there's any other questions coming through at the moment. In the email, we've also had a request for the recording to be sent. So I'll include that in the email that we do send you out as well. Of today's presentation. If you'd like to revisit the content or perhaps share that with one of your colleagues, you'll be able to see that recording of today's session. Excellent. Well, thank you very much, Georgia. That's been fantastic.
Thank you very much, guys. Thank you for listening. And again, I'll make sure you've got the right method of communication so you can touch base and ask any questions that might spring to mind. Thanks again. Thanks, Stephanie.
Okay. Thanks for attending, and you'll be receiving an email from us by tomorrow morning. Bye-bye.